7 is about property dispositions. We're talking about selling or exchanging long-lived assets, basically land, equipment, things like that. So in the first part of this chapter, we're going to talk about how to compute the gain, and then talk about what's the difference between realized and recognized gains and losses. How do you determine basis in the gain-loss transaction? Some various disallowance provisions for losses, and something called like-kind exchanges. We're going to ignore learning objectives 6 and 7. So let me scroll down to learning objective 1. This section talks about how to compute the realized gain or loss. This term realized just means that an event has occurred between two parties where property has changed hands, and the seller in that kind of situation is going to have a realized gain or loss in every sense. In a few minutes, you'll see down in the next learning objective how realized is contrasted with recognized. Recognized means you actually have to put the gain or loss on your tax return, and it affects your taxable income. Not every realized gain or loss is recognized. So we're going to talk about a few provisions that cause differences, but the general rule is realized gains and losses are recognized. So we start off with this idea that a realized gain or loss is the amount realized from a sale or other disposition minus the adjusted basis of that asset. And we'll talk about what adjusted basis means in more detail later, but basically, for simplicity's sake, basis is pretty much what you paid for an asset. So what you sell it for minus what you paid for it, and that's the gain or loss. If you sell it for more, it's a gain. If you sell it for less, it's a loss. These issues do get complicated, so there's more to it than what I just said. There's other kinds of sales or dispositions, not just a straight sale, things like trade-ins, casualties, condemnations. We're pretty much just going to deal with sales and trade-ins to a certain extent, sometimes called exchanges. So in calculating the realized gain or loss, you first start with the amount realized. That's basically the proceeds that you're getting from the sale. And there's several things that could be included in proceeds, not just cash that you get. Money is part of the proceeds, but also fair market value of other property you get. There's the possibility of real estate taxes being part of the proceeds too. Like what if the buyer pays property taxes that are really the responsibility of the seller? That's essentially extra value going to the seller. In addition, things like we're to talk about mortgages or liabilities assumed. Right here, amount realized also includes liabilities on the property disposed of, such as mortgage debt. So if the buyer assumes the mortgage, then that is additional proceeds to the seller. Basically, the seller had debt and the buyer took it over, so the seller doesn't have debt anymore. That is incremental proceeds. Keep scrolling down here. It talks about fair market value. Adjusted basis, and what is that then? So we talked about the gain or loss being the difference between the proceeds and the adjusted basis. Here the adjusted basis is defined, pretty much starts off with the cost of an asset plus capital additions. That means major improvements you've made to the property, like putting on an addition or putting on a new roof. Minus capital recoveries, those are discussed in a few minutes. Primarily depreciation is the main cost recovery, or capital recovery, although there are other kinds. And so that math gives you the adjusted basis in your asset on the date of disposition. The book goes on to describe capital additions, capital recoveries. There's depreciation and other cost recovery allowances. And I think that will take us to learning objective 2. I'll pick that up on the next video.